Maybe you can help me out. Here's the situation. I'm getting ready to sell an option, and I need to decide on the strike price. Now I can pick an at the money or near the money strike price, which pays more premium, or I can pick a strike price that's out of the money and pays less premium. Now with an at the money or near the money strike, it's more likely to get exercised, and with an out of the money, it's less likely to get exercised. Watch this video as I use an example to compare the options and discover how I use an options delta value to help predict the outcome. Did you know that I host an options trading community for traders just like you and I? And it's completely free. This community it's where we share tips, tricks, hints, and secrets about options trades we're currently doing or in the process of doing. We also share other helpful educational information about executing covered calls and cash secure put. If you're a new or beginning options trader and you want to learn how to trade options trade the simple, easy way so that you can generate a regular monthly or weekly income, then be sure to join my community over at school.com/simpleoptiontrading. I'll leave a link in the description down below. I hope to see you over there. Well, now let's take a look at the covered call option that I'm considering selling. So I opened up my trading platform on my smartphone so I can access my brokerage account online. And I brought up the ETF that I own. It's NVDX. So this is a 2x leverage ETF that tracks NVIDIA stock. So as some of you may know, a 2x leverage security, it reflects the movement of the underlying stock that it follows. In this case, it's NVIDIA. But keep in mind, it's 2x leverage. So as NVIDIA moves, this ETF will move twice as much. So if NVIDIA goes up 1%, then this ETF will go up 2%. And by that same token, if NVIDIA goes down 2%, well then this 2x leverage ETF will go down 4%. So it's got some volatility in it, but I like that as an options trader. It gives me access to some higher premium. Now let's go ahead and take a look at some of the option selections that I have available. So I'm going to go over to trade options and I'm going to use August 15th as my expiration date, which is at the end of this week. So it's about 4 days. Now I'm looking at the strike price of $19.50. You can see it right here. And if we take a look at the details, we can see that this option has a delta of 0.38. So still a little bit high, but that's okay. I'm okay selling my shares. So having a delta of 0.38 works out fine. There's enough open interest, 246, and the bid and ask is 30 and 35 cents. So in that case, I'd be able to ask for 35 cents. But now let's take a look at the option for a $19 strike price. So this would be an at the money call. The delta is 0.53. So basically it's a 50-50 chance. More than likely this option would get called away. There's plenty of open interest and the bid and ask is 50 cents and 60 cents. So for this particular option, I would request 60 cents per share as the premium payment. Armed with the information from those different option choices, I can now do an analysis by comparing to see which one might be more profitable. So here we can see my covered call analysis. This first one is for NVDX. Currently the market price is $18.83 per share. I have 100 shares. That's just enough for one contract, which gives the total value right now is $1,883. Now, because I'm looking at an expiration date of August the 15th, that makes the length of this contract 4 days. Now, we saw the first contract I looked at was with a $19.50 strike price, which is currently paying 35 cents per share as the premium. Now, my cost basis for the shares that I own here is $19 per share, so it's worth $1,900. So if the option contract does get exercised, I would receive a payment for my shares of $1,950, and that would give me a price appreciation profit of $50, and that represents a profit of 2.63%. Now, when I initially sold the option contract, I would receive $35 as the premium payment. Remember, it's 35 cents per share, and there's 100 shares on the contract, so that's how I get to the $35, and that represents a return on my investment of 1.84%. So that meets my criteria of number one, is it profitable? And number two, am I getting at least 1% per week? And I am. I'm getting 1.84 if it's just the premium. Now, if the option contract does get exercised, my shares are assigned to the buyer. I will receive payment for my shares. And in addition, I keep the premium payment that I receive. So all the money that I would receive would be a total of $85. And that would represent a profit of 4.47%. So almost 4.5% for this 4-day trade. But then let's take a look at the same stock that I own. But we're going to be using the different strike price, right? We're going to use the $19 strike price, which is currently paying 60 cents per share as the premium. So almost twice as much as the premium payment. And that's because this is an at the money option contract. So I have the same cost basis, $19. And if my option contract does get exercised, I would be paid for my shares and I'd receive the $1,900. So there's no price appreciation profit, right? So I paid $1,900 and I received $1,900. So there's no gain there. No gain or no loss there. But I did receive $60 as the premium payment when the option contract gets filled. And that represents a profit or return of 3.16%. So I'm getting a higher return on my investment if you just look at the premium. So if we take a minute and look at the side-by-side analysis, we can see that the clear winner in this case, the option that has the highest overall or the highest potential profit, is the one where the strike price is $19.50. And it's pretty obvious, right? It's because the strike price is set high enough so that there's price appreciation, right? So it's $19.50 is the strike price. The cost basis is $19. And so if this option contract gets executed, then obviously there is a price appreciation of $50, right? It's the difference between the $19.50 and the $19 paid per share times the 100 shares, or $50. So that's if we work off the assumption that the option contracts get exercised. Either case, whichever case we go, the option contracts get exercised. Then the bottom line, total profit, obviously then the one with the higher strike price, the $19.50, gives the higher profit potential, right? Just under 5%, or just under 4.5%. But if we take a look at the delta values, we can see that the $19.50 strike price has a lower delta value. It's 0.38. So there's less likelihood that this option would actually get exercised. In contrast, the one where the strike price is $19 exactly at the cost basis, we can see that the delta value is 0.53, which means more than likely, right? So there's better than a 50-50 chance that this option contract would get exercised and my shares would get assigned. And now if we contrast that to the other option that has the 0.38 delta, let's take a look at the case where, let's say the price finishes at $19.01 or $19.49. Then in that case, the first option contract would never get exercised, right? It would expire worthless. The $19.50 never got reached, and so that option contract expires worthless. Whereas the other option contract, the one with the $19 strike price, that one does get exercised, and so the entire profit is from the premium collected. In that case, it's $60, and that's a 3.16% profit or return on the investment. Whereas in the first case, the one with the $19.50, the premium received is only $35, and the return on the investment is 1.8%. So that's where the balancing act comes in, and you need to determine how willing are you to have your shares assigned and get paid for them at either the $19 strike price, which is exactly what your cost basis is, or do you want to risk the chance of not having your option contract get exercised at the higher strike price, even though you are collecting some premium. So you've got the details behind each of the option contracts, and I shared the comparison with you. So now, do I go with the higher strike price and the lower premium and the less likelihood of getting exercised? Or do I go with a near the money or at the money strike price, which pays a higher premium, but it also has a higher likelihood of getting exercised and me having my shares get assigned to the buyer? You can help me decide by leaving a comment down below.